We're going to do this thing. Thanks for coming out. Great turnout. Glad everyone's excited about taxes. Short-term rental loophole, cost seg. If you're making some serious money with your rentals, this is going to save you some serious money. If you hope to make some serious money in the future, this is a very good topic to have in the back of your mind. So glad y'all came out. Make sure you network with people, meet somebody new. This is the House Hacker Mafia. My name is Ryan Thompson. This is Tanner Pyle. We put it on. We are both house hackers, investors, and we are real estate agents that help investors and house hackers. If you got any questions, come ask us. Dan is our speaker tonight. Super knowledgeable. Recommend sticking around and talking to him at the end. Give it up for Dan.
In real estate, first impressions can make or break a deal. Whether you're listing a home for sale or marketing an investment property, having high quality photos are key at grabbing attention. If you want to stand out in the competitive Colorado Springs market, having high quality photos is essential. And Wayne over at Homadi excels at getting the best possible photos for your property. He is based right here in Colorado Springs and specializes in capturing properties in the best light. If you're ready to take your property photos to the next level, make sure to contact Wayne over at Homadi and mention you heard about him from Tanner at Red and Joy Real Estate to get 20% off your next shoot. Remember, great photos can make the difference between a quick sale and a stale listing. So make sure to contact Wayne over at Homadi today.
Yeah. I've been very conflicted about wearing my Nebraska hoodie ever since this last Saturday. But after we beat Colorado earlier this year, I was more proud of it. But anyway, I guess this is what made the cut for this. So yeah, tonight we'll talk about cost seg studies. And just by a show of hands, who is like very familiar with cost seg studies? Just so I kind of know. 1.5. Okay. Has anyone ever heard of the short-term rental loophole? All right, 5. Okay. Well, this should be good then. Who invests in short-term rentals? What are the rest of you doing? No, I'm kidding. Who wants to invest in short-term rentals? All right, good. We're getting better. Okay, so this is very applicable to short-term rental loophole, obviously, but I will also talk about long-term rentals and how it applies. And I have an example of a cost seg study on one of my long-term rentals. And so I'll kind of show you that because it shows you what we're going to talk about. You know, the benefit of a cost seg, bonus depreciation, if you're familiar with that, and then some of the limitations of that. And we're actually kind of on a timeline with this, if you didn't know. So 2027 will be a sad year when some of this goes away. So with that being said, I do have a disclaimer. So I am like a licensed investment advisor in Colorado. So this is not investment advice, legal, tax, or accounting advice of any kind. Not making any specific recommendation to buy or sell anything, okay? So don't do anything dumb based on this. So what I thought would make the most sense is to start with the end in mind. Otherwise, I think you just get lost potentially in what this is and why it even matters, okay? But the big benefit of doing this is that you can save money today that you can then invest. So you either get more dollars to invest in a property or to spend or whatever it is you want to do, but it gives you your money today rather than having to wait over time. So when we talk about the principle of time value of money, you always want your money today. And if you're willing to not get your money today, you need to be willing to accept a certain rate of return. So in investing, that's called the discount rate. So whether it's the stock market or real estate, I have a certain rate that I'm not willing to put my money at risk to get it back at some point in the future unless it beats a certain threshold. As investors, you should each have a threshold. So if you don't have a threshold, then you may be subject to, and I don't mean like sub to, but you'd be subject to either mediocre returns or you just have no clue where your return is. And as a financial planner that works with real estate investors, I see that all the time. People thinking like they're getting a 10% cash on cash return, not realizing they're getting like a 3.6% return on equity. And they've completely missed, you know, the forest for the tree right in front of them. So that is where this is so important. So as we go through it, I like to be interactive. So if you guys have questions, or if I didn't explain something clear enough on the slide or verbally, please just go ahead and raise your hand and ask. And I'd much prefer to address that as we go. So to talk about cost seg, we start out with depreciation. So depreciation happens on every rental, okay? So if you think about buying a new car, I think this is the easiest example. Let's just say $30,000 on the lot, brand new. You buy it, you drive off. We've all heard it's immediately worth like 20% less, right? And then we know that every year that car goes down in value. That's depreciation. So this is what Robert Kiyosaki was talking about when he said the middle class tends to buy assets that depreciate in value, and he calls those liabilities, where the wealthy build assets that appreciate in value. Real estate depreciates while it appreciates, okay? So this is a pretty awesome thing. When I started to grasp this is when I went from being a real estate skeptic to really buying into it and loving it, honestly. And then when you start to appreciate and I need to come up with a better word than appreciate when I'm talking about depreciation and appreciation. When you begin to love depreciation and appreciation in real estate, that's when I think you'll be able to take max advantage of it. And then what you want to do, to even go further to the beginning, you want to start looking at properties that have better depreciation potential than others, and then obviously better appreciation potential. But the depreciation is key because it gives you your money today. So we all know things break down. The government realizes that, the IRS realizes that. And so what depreciation on real estate does is it says you have this building, let's say it's all brick, but it's not going to last forever. And there's parts of the building that won't last as long as the brick outer walls, right? So they let us depreciate properties over 27 and a half years. Yep, okay, that's the slide. For residential properties. And then for commercial properties, they're depreciated over 39 years. Now, of note, short-term rentals are commercial properties, according to the IRS. So think hotel, okay? Hotel, motel, Airbnb, those are commercial. So they're depreciated over a longer period of time. So if you had a $500,000 short-term rental, which one of those two depreciation, 27.5 or 39, which would be more advantageous to you? Right, the smaller number, right? You want to get more money sooner. So 39 years spreads that out a lot further. So what comes into play now is, well, how can we capture more of this than just, I can't remember what the percentage is, but it's like a low, like 2 point something percent of the building per year over 39 years. How can we get some of that sooner? That's where cost segregation studies come in, and then the Tax Cut and Jobs Act. I made the note about when the property is placed in service, but that's just kind of a note to remember. So there's two types of property that can be depreciated as it pertains to real estate. There's also Section 179, but that's different. That's like equipment and stuff. So Section 1245, you can think of this as everything that's in the building, whereas Section 1250 is the building, okay? So Section 1250 will always be depreciated over 27.5 or the 39 years. The stuff inside, those components that, like everything we can see on the walls in here, that would be depreciated under 1245. And so you can see 5, 7, 15-year property. So if you don't do a cost segregation study, let's say that he buys that $500,000 house. Let's say the land is worth 100, so you subtract 100 from 500, you get $400,000 for the building. You can then depreciate that, so you depreciate $400,000 over 39 years. That's roughly, what, $10,000, a little more per year, right? But that's for everything. So a cost segregation study goes into the building and says, the HVAC is worth this, the flooring is worth this, the drywall is worth this, the sink, the cabinets, everything, every single thing has depreciation. And then once it splits it out, now you can accelerate it to where over 5 years you capture all this. Over 7 years, you capture all the cost of this other part of it, and then so on. And kind of got ahead of myself there. So with the accelerating your depreciation piece, that comes into play with the Tax Cut and Jobs Act. So before that was passed in 2017, you could accelerate some depreciation at varying levels. But what was so awesome about that law is that for a temporary amount of time, they allowed you to take 100% depreciation. So I'll show an example of that, but that obviously lets you take a massive loss in year one when you purchase the property, and then you basically get free income off that property up until the depreciation's used up. Now, tax-wise, what's really cool about Schedule E is you report your rental income at the top, and then you report all your expenses and you list them out. And then at the very end, there's a line for depreciation. All those expenses that are deductible, those actually cost you money, right? Like you actually had to pay property taxes. You actually had to have insurance. You had to do maintenance or have property management or whatever it is, right? Depreciation doesn't cost anything. So it's considered a non-cash expense. That is free money that is offsetting income, making a portion of your rental income tax-free. So that is why you should get excited about this. So one of my strategies is build up as much depreciation and loss as I can, and then I get rental income tax-free until I use it all up, and then just repeat that cycle. I kind of hit on this. Oh, go ahead.
Does this work for both short-term and long-term rentals?
Yes. Yes, it does. So why would you want to accelerate your depreciation today? Kind of hit on this, but there's a key point.
Because we only have 2 years left and we only have a month and a half left. In
Well, that's one good reason. Yes. So what he's getting at is the Tax Cut and Jobs Act expires. So 2027, this bonus depreciation and the ability to accelerate it is 0%. So then unless, depending on what happens with the election, unless that gets extended somehow by Congress or a president that decides to make it permanent law, that will go away. And so then we'll be stuck over these lifetimes doing it, which is still beneficial, but not as beneficial as getting it all today like we want. But again, the benefit is that, like I was saying earlier, if I invest money and I'm not going to get it back until the future, I want a certain amount of rate of return to make that worth it, right? Bonus depreciation or accelerated depreciation gives me a larger chunk of that back today. So again, time value of money. You want as much coming back to you today as you can, because inflation is going to erode your investment return over time. So you want that dollar today, unless you can guarantee a high enough rate of return over the future that makes it worth leaving that money out there at risk. So bonus depreciation gives us more back today in the form of tax-free income and tax savings. So I think I've covered that. All right, here we go. So this year we're at 60% bonus depreciation, and then next year it drops to 40, and then it's 2025. 2026 it drops to 20%, and then 2027 it goes away. So I'll show you an example. All right, so this is a real life example, and that is actually my real building. And this is the real numbers that came back from the cost segregation study on it. So remember I talked about 1245 property and then 1250. So they put the purchase price was 730, and then you subtract out the land. And they appraised the building at $540,606.20. And this is a team of engineers, by the way, that comes in, they walk the building, take pictures, document everything, and then they go back and I don't know what they do, but they give you this, okay, cost segregation report. And so what they said is that of my 730, 540 was due to that. 2156 was due to land improvements. It's a pretty ugly location, so not much going on there land improvement wise. And then 5-year property, they did 1245. That was 133,000. That's the number I'm looking for. That's a big amount. So if you add that all up, 676,000, and then if we subtract 730 minus that, that's the land value. But if we add those the 1245 5-year and then the 15-year property together, that's $136,000 of losses I was able to deduct in 2022. So I didn't make that much money in 2022. And this is a long-term rental, by the way. So I'll talk about a couple scenarios and how this would play out. But what that means is that the next $130,000 I make in rent is tax-free. says I have the losses to offset that, okay? And again, I didn't spend $136,000 to offset $136,000. No one gets excited about that, right? That's kind of a break even. This is all a free $136,000 tax benefit. So if you take whatever my effective tax rate was, which is when you file your taxes, you usually get like an effective tax rate number back. If you take that times this, that's how much it saved you. For us, it's probably like $28,000 or $30,000 in taxes that year, just for this. And that's with me not being a real estate professional, not, using the short-term rental loophole that we're talking about, right? So massive tax savings today. So what's the opportunity cost? Now I have more money I can invest, or I can do, whatever with, right? Is everyone kind of following how this part works? Okay. 2022.
That same year.
Yep.
I'm a little confused on the total 136,000. How is that distributed? Is that distributed to you in lump sum, or is it spread out over years?
So I don't get it.
Okay.
So the IRS doesn't write me a check for that, right? It just goes on my Schedule E, and then it carries forward. And I always forget these. I want to say 85, 86, but I think that's wrong. It goes on another tax form, and it's carried forward as what's called a passive activity loss or passive loss. It falls under the section 469 of the Internal Revenue Code of passive activity loss rules. So again, because I'm not a real estate professional, I can't use it. But let's say that Ryan and I traded places. He is what's considered a real estate professional. Let's say he made $136,000 that year, and then he had this loss. He could have used this to wipe out his income and paid no taxes. So that's the benefit of being a real estate professional. For me, I'm just carrying those forward. So I don't get that money back today, but that's where I was saying the next $136,000 I make, I do get that back in the form of not paying any taxes on that.
I see. Okay.
Yeah.
So basically, it's like a reserve, a tax reserve that you can use towards your taxes in the coming years until you've exhausted.
Yep, exactly.
Okay.
And so here's one of the big benefits too, and I'm going to get your question in just one second. Here's one of the big benefits too. Let's say I sold this property in 2024. I took all that appreciation up front. I didn't own it for 5, 7, 15, 20, or 27 and a half years. I still get to keep all that depreciation benefit. So you can take a massive loss up front and almost like churn properties and keep getting the depreciation. Now again, that's not prescriptive. I'm not saying you should all do that, but I'm saying if it makes sense. This is where I tend to see a lot more of the long-term buy and hold investors get in trouble, where they've owned properties for years or decades. They have almost no depreciation. They're having basically no tax benefit because the only deduction they get comes from their expenses. Depreciation is what drives returns. So this same property would have a different return on investment with a cost seg study versus without. So get it. Which one? Oh, sorry, you.
How do you hire somebody to do a cost segregation?
It's pretty easy. You just Google cost segregation. But there's better companies than others. So to be honest with you, this was my first one. So I went with a bunch of recommendations from like Bigger Pockets and another group I was in. And of course, everyone recommends the cheapest guy. Well, I found another guy, and he went through this, and he was like, we could probably get you another $90,000 by doing something different. So as soon as I'm done renovating this property, because it's been taking me forever, I'm going to do a second cost seg on it. So you can also do multiple cost seg studies. And what this first company did, being cheap, they did not do what's called partial asset disposition. So this was a very old building as it looks. There's a lot of crap in there. They took a lot of crap out, put new drywall, new wiring, ripped out old terrible kitchens, put in new cabinets. They never deducted the value of those cabinets or the old drywall, and you can actually recapture the value of those things. So all the trash that my contractors threw away, that actually had a depreciable value on this, which is insane. And I didn't know that at the time. So there are better companies than other. I can make a recommendation when I'm done. I have a guy that I've become friends with because I've learned a ton of this from him, honestly. And I think he works for a more reputable company. But for comparison, I think I paid like $3,800 for this, and that guy would charge closer to $7,000. but it is way worth it. So yes, what was your?
Question, what's the average cost of a segregation assessment? And then you mentioned it's on like a sliding scale, like it's allowed now and be allowed less. Who's the authority who's making those rules?
Well, so when Trump was president, he passed the Tax Cut and Jobs Act, and it was in effect until December 31st of 2026. And then we say it sunsets. So I don't know if everyone remembers this, but the 15% tax bracket dropped to 12, the 12 dropped to 10, 24 dropped to 22, 27 dropped to 24, and then the other higher brackets that most people aren't in. Everything went down, right? So that was only a temporary benefit. That was not made law. It was just an act. And so on January 1st, 2027, if you're in the 12 now, you'll be in the 15. If you're in the, 22, you'll be in the 24, and so on. So basically, we got a temporary break, like a timeout from the regular tax law. We got a little break to stimulate recovery. And then unless someone extends that or makes it permanent, we go back to what we were doing before. So we're in the position of being passive in this. So nothing has to pass for things to change. Something has to pass for things to stay as they are. So understand that, because that's different too. Yes.
So you know how it's like slowly fading out until 2027, it was used to be at 100% of the by like 60 now.
Mm-hmm.
Is that based off of the year that you do the cost segment or the year that you bought the property?
Good question. Bought the property. So again, like I bought it in 2022, so I can do a second one and we can still do 100% for 2022. So if you bought one in 23 or 24, you can still do the cost seg later. And then one more thing with cost segs, I've not seen this myself, but I've heard that a lot of cost seg companies will try to force those in before either October 15th, which is passed, or before December 31st, and they'll say it has to be done the same year, but it does not. But I will say, from a lot of the CPAs, kind of the group that I am in, I guess, they say the longer you wait, the less it becomes worth it. There's an accounting form called 3115 that if you have to get that changed to go back so far, that alone costs anywhere from like $3,000 to $5,000 just to update that form. And so this is something better to do sooner. So like strategy-wise, I would be thinking, buy a property, renovate it, cost seg, bonus depreciate ASAP. It's kind of the cleanest way. Did someone here have a question? I'm gonna get. Let me get him.
How long do you have to the 136 to use that?
There's no expiration. In fact, one kind of cool caveat, not that I would do this, but even with that 136, let's say that for whatever reason this year I decide I hate real estate and I want to completely divest and get out of it. Even though I'm not a real estate professional, I could take that loss and apply it against our income in the year that I sell everything. So if you liquidate your real estate portfolio, then those passive losses like unlock and become able to be applied against your active income. Over here.
The 136 that you're taking as accelerated depreciation, doesn't that lower your cost basis?
It does.
Property, so when you sell, you immediately sell the next year. Now you're paying taxes for the capital gains taxes if you kept it for 2 years on $136 more $1,000.
Yes. So I think I had this maybe on a slide. I can't remember. I'm sorry. But I had depreciation recapture tax on there somewhere. So depreciation recapture tax is what he's talking about. If I were to go sell this property today, they would adjust my basis down. So that's why it's called an adjusted basis, right? Some things get added to it at closing. Some things like this and regular depreciation subtract from the basis. So if I sold it, I would have to pay taxes as if I had bought it for, we'll say $600,000, just to be easy, right? So it's kind of like now I've got to pay taxes on it, and depreciation recapture is taxed differently. It's because it benefited me at my ordinary income rate, I have to pay taxes on it at my ordinary income rate, up to 25%. So it is capped. But there's a silver lining in everything, because I'm not just going to sell. If I 1031 this, I can roll that into the next property, and you just kind of 1031 until you die. And at the end of the time, guess what? Depreciation recapture tax wiped out. Your heirs get the step up in basis. There's no tax ever paid on something like this that gave you money today.
If you're planning to get photos done on your next listing or rental property, don't forget to reach out to Wayne with Homati to get 20% off your next shoot.
So I will say too, yes, so maybe I made it sound a little too flippant, like, cost segs for all of us, right? Like Oprah. But think about it. Think about your holding period, your exit strategy. But just know that if you start doing this, 1031s pretty much become your way forward, or you're going to have a massive tax bill. On the other hand, though, a guy I'm working with, he's owned a property in Steamboat Springs that he was telling me about. He's going to have over $1 million gain. He's owned it for like 30 some years. He told me he's out of depreciation. So he has depreciated that property fully. So when he sells that property, the only thing that won't be taxable is whatever the value of the land is 30 years ago when he bought it. So I don't know what that would be, maybe $30,000, who knows? But he's going to have like $1 million taxable gain because depreciation has lowered, he's deducted it all, right? So again, that's a good example of why 1031ing every so often. So I'm a big fan of, analyze your rentals, whether it's short-term or long-term. Analyze them, see where your internal rate of return is and your return on equity. And if it's going up, usually after renovation, and then it kind of peaks, if it starts going down, might be a good time to consider 1031ing, because you're either going to ride that curve down and all the hard work you did early to get that high return early, that gets watered down the longer you hold that property. And again, that's part of the time value of money. And so you don't want to water down that return, because you could turn a 30 or 40-year return over like 2 to 3 years into like an 8% return if you hold it for 10. So just think about that. Keep that in the back of your mind.
Do cost segregation studies have to be repeated, or do they just kind of give you, hey, here's the schedule for all of these items?
Yep.
Just do this every year?
It's a one-time thing. So yep, this is where it's important to work with a good CPA or tax professional that does real estate. So yeah, if you're investing in real estate, you really need a good CPA. I would never DIY a tax return with something like this. The odds are you're going to lose it when you go to do your next year's taxes. If you don't, some of these forms aren't part of your tax return. So, your tax return is the 1040, right? You can go through, whatever it is and do your taxes. But if you don't enter this information in some of the forms that are like on the side that aren't part of the return that has to get filed, you will lose these. So I've heard horror stories of that where people lose like hundreds of thousands of dollars of depreciation benefit. One time is when they switch CPAs. So that's one dangerous time, because since those forms don't have to get filed, your CPA may have them in your file. And I don't do taxes, but I've helped a tax person do them. And so they have forms that are like in your file, but not part of your 1040. And so you might need to go to your tax person and be like, hey, I would like my entire record. I need this form, this form, this form, and this form. And then you take that to your new CPA, and then they have a starting point. But that's one of the most common times I've heard that people lose this benefit. The other time is when they DIY it and they just don't even know that that needs to get recorded in the first place. So. All right, so this is a screenshot from my Schedule E. So again, you can kind of see at the top there, the, I guess this doesn't point at the thing. 73,000 of rental income is what it made, right? So someone was asking, we're talking about like, do you get a check? I think it was you maybe. You don't get a check, but I don't pay any taxes on that 73. But this year, as you can tell, was like a heavy year in renovations. So I had a ton of expenses. And oh, actually, this was my second year, so the big loss isn't there. So you see just the 21, that's what's left after the other stuff. But again, that 21,000 is now, everything else there is an expense, but that $21,000 is how much of my rental income up above that's now shielded from being taxed. So again, my example was if I had an effective tax rate of 10%, that would in effect save me $10,000 or $2,000 $107 that year. Yep, so there we go. There's the depreciation recapture tax. So how this applies to short-term rentals. This is different than long-term rentals. So we all call rentals rentals, but in the Internal Revenue Code, a rental property actually has a rented average duration of stay of over 7 days, and a non-rental, or they just call it nothing, has an average duration of stay of less than 7 nights. So that is short-term rentals by definition. And again, think about hotels. This was written, decades ago with hotels and motels, and the average nightly stay was less than 7. And so they're able to depreciate things differently and treat the business a little bit differently. So that is what this section is more on for you guys. So if you want to read more specifically, again, Internal Revenue Code 469, very important. Publication 925 is actually a more palatable, like paragraph type reading. That is a really good resource. I would 100% read those at some point if you're a real estate investor. There's a lot of stuff you might read where you realize you heard people talking about doing something wrong. A lot of questions get answered there. And this is where that loophole comes from. And by the way, it's not a loophole. So we often think of loopholes like, oh, the rich are using a loophole, right? A loophole is just referred to something in the tax code where people are able to use it in a way it wasn't intended. So with short-term rentals, Airbnbs weren't around in the 1950s when a lot of this tax code was passed. So again, it was aimed at hotels or motels, and that's why it's a commercial property over 39 years. Now Airbnb came around, and you guys now have little hotels, right? And so you fall under this. So technically, short-term rentals are not a rental activity. So that's why you don't need to qualify for the real estate professional status. So this is pretty cool, because to qualify for reps is pretty tough. To qualify for the short-term rental loophole is way easier. And then all of a sudden we can do that cost seg study and use that depreciation and all those losses against your income. And that is how, if you could be a high income earner, a W-2 job, and have a short-term rental, that you can use the losses on to wipe out a portion of your income. So we got through all that stuff we just talked about to say that.
Quick question.
Yep.
So can you say that one more time? You can use the losses to wipe out a portion of your W-2
Yep.
income?
Yep. So that is the benefit, because Internal Revenue Code 469 was added to the tax code to prevent people from being able to do that. So just a little bit of history. Before like 1984, I think it was, wealthy people would buy real estate, depreciate it, and then reduce their income immediately. And the IRS is like, well, that's not fair. So they made 469, and then they actually for a while wiped out any ability to offset income with rental losses. But then by the early 90s, like real estate developers, real estate agents, contractors, people who actually work in what they call real property trades and businesses, they lobbied hard enough. They're like, we're actually in the field. This is our job. We deserve to do this. So they added these kind of exceptions. And that's where what's known as the real estate professional status came from. So if you work in one of the 11 real property trades and businesses, you can qualify as a real estate professional as long as you meet certain requirements. It's not as simple as just being in one of those fields. But again, with short-term rentals, you don't have to do that anymore. You could be a doctor or lawyer or nurse or a teacher, and you could do this on the side. And as long as you qualify, you could wipe out your income with those losses. So again, said that's a good link to section 469. So there's two criterias. So again, to be a short-term rental, the most common one is that your average duration of stay is less than 7 nights. So if you do that, it's cut and dry, you're a short-term rental. The second one is a little less common, but this, you might think of like a bed and breakfast. This is if you provide significant personal services. So if you have an Airbnb and a tenant stays for 6 nights, and then they leave, and you go in, do all the cleaning, all the laundry yourself, you put a little chocolate on the bed, and run the dishwasher. You did not provide significant personal services while the tenant was there. What would count as that is like turnover service, or if you made their bed while they were staying there, or if you went in, put in new towels, I don't know, robes or something, you swept the floor, did whatever it is while they were staying there. So if you do that type of service, then you can have an average duration of stay of up to 30 days, and you provided the significant personal services. One key difference between those two, the top option, you report the income on Schedule E. The second option becomes a self-employment business, and you actually report it on Schedule C, and you have to pay self-employment taxes. So don't do that. No one has time for that.
That's it. Or you have to do this now too.
Oh, yeah. No, I have one more thing.
Oh.
Yeah. So this just tells you if you can qualify. So if you meet one of these two, you're eligible for the short-term rental loophole, but now you have to meet one of these material participation tests. And this is kind of the linchpin. If you don't do this, there are lots of tax court cases. If you get audited, you will get busted. So, don't cheat, don't lie. There's a lot of court cases about this. Most cases never even go to tax court. It is very well established what counts and what does not, and you must meet one of these. So the ones that are highlighted, those are the most common ones that people could potentially qualify for the short-term rental loophole. So to put a couple strategies with this, let's say that you're buying a property, it needs a lot of work, you want to make it an Airbnb, you're handy enough, you can do the work yourself. So you work on that property, maybe nights, weekends, take some time off, but you put in 500 hours, and then let's say you buy the property in July, you're done by October, and then now you place it for rent on Airbnb and you start to get tenants. If you manage that property, by the end of the year, you would qualify for the material participation test, and then you could do a cost seg study, and then you could use, we'll say that $136,000 of losses, and you could wipe out your other income from the job that you go to. And then it gets even better. The next year, you don't need to do this anymore. Then you can hire a property manager and go back to work, and you don't have to keep doing this. So this is a pretty awesome kind of one-time thing. And if you time it right, kind of based on tests 2 and 3, so let me say this first. So, test 2 is your activity substantially constituted all the participation. So basically, if you don't hire anyone, if you don't have any cleaners, if you don't have any property manager, if you don't have, anything else, if you're doing all the work yourself, that would count as material participation. And then test 3, if you spent at least 100 hours or more and no one else spent more than you, that's a key one, because there you can start to share the burden a little bit. So you could hire a property manager. The key point on this is you need to track their hours. So there are actually tax court cases where people claim this, they took the bonus depreciation, wiped out income. When they got audited, they weren't able to provide a log of the hours for their property manager, and they got thrown out because they couldn't prove that they worked more than their property manager on that property. So a couple of tricks, people recommend putting the key codes or the door pad codes, whatever they are, on the door so that everyone has an individual code to get in. That's one way you can measure, like my property manager came, they were there for this long over these 4 months. I came, I was there longer, or my cleaners came, they were there less than me. That's one way to measure it. The other thing is time logs. So you just have to track time. And the more detail, the better. So again, some kind of tips and tricks from the tax court cases. The people who have had either reps cases or short-term rental loophole cases, the ones that have had it stand, they have a time log of, the date, the exact times, why they went there, what they did. And if there's a receipt, like I stopped at Lowe's for a new doorknob on the way, you have a receipt attached to that shows a timestamp on that receipt, like I was doing that. So record keeping is key. So definitely do that. So again, if you meet one of these two, criteria, you meet just one of these material participation tests, then you can deduct those big losses against your other income. So part of the strategy is do this towards the end of the year so that you don't have a full 12 months that you're trying to work on a property. Try to get it to like 2 to 4 months, depending on what, I guess, condition and maybe how much work the property needs. Do the work yourself, manage it yourself, suck it up, get through that point, and then the next year you can offload it a little bit. But that, in essence, is the strategy.
Yeah.
Like,
That's a question.
yep.
So if I bought a short-term rental now, and we close first week of December,
Mm-hmm.
and I go over there once to take out something gross in the fridge, and I don't put it on short-term rental until January 1, I guess I have to have a stay, right?
Yep.
If I have one stay and I manage it, and then I can do all of that, and then give it to property manager January 1.
So the number of stays is something that is not in the tax code. So it says average. So to get an average, they have ruled you have to have at least 2 stays. So one of the tax CPA or real estate tax groups that I'm in, they recommend a minimum of 3 stays that average out to less than 7. That way you can prove intent. So the tax court, just so you know too, like in America, if you get arrested leaving here, you're innocent until proven guilty, right? In tax court, you're guilty until you prove that you're innocent. So Ryan, if he did that, he would be guilty the instant the auditor shows up, right? Or the instant he gets a letter from the IRS, he's guilty. Okay, and then he's got to prove his case. It's not the other way around like it might be with criminal court, okay? So what I would say is, kind of, you could buy the house, close early December, do some work on the house, get it rented out, because the IRS looks for intent. And this is even how you can get around 1031ing a property. You can only 1031 rentals. So say we're talking about a long-term rental, and you've only owned it for 10 months, and you're like, you know what, this property sucks, it's not what I thought, I am moving into a new property, and I'm gonna 1031 it. If you're less than a year, that could be considered iffy, because that's when property held for sale less than a year is considered inventory. That would be a Schedule C activity and not a rental, whereas property held for over a year would be considered a rental and a long-term capital gain. That's what you can 1031. But there are tax court cases that support 1031ing over shorter time frames than a year if you had the intent of making it a long-term rental and it's reasonable to see that it didn't work out and you adjusted course and decided to sell. So the same with this. If they look at it and they're like, Ryan, you took out the rotten milk that was in the fridge that was stinking, but you had, one rental on it, for one night, and we did a name check, and it turns out it was like your sister with her new husband's name or something like that, so we didn't catch they were related at first. They'd be like, that was not your intent to have a short-term rental, and they would reverse that. So just know too, the IRS is big on intent. So prove intent. That's where the paper trail comes in. All the receipts, the logs of time, all that kind of stuff. But with that said, again, the average duration of stay, so definitely 2+ stays, and the more stays you have, the more solid of a case you have. And then make sure you track your time and everyone else's time that does anything on the property. One strategy I've heard of too is with cleaners. If you have it says person explicitly in the tax code. So one strategy I've seen people use is if they have a cleaning company, they request a different cleaner each time, and then they log that it was a different cleaner each time. So the cleaning company might have 400 hours, you might have 110, but there's like 6 cleaners that went through for 30 hours each or something, Yes.
If, let's say someone's trying to do this in 2024, so between now and December 31st.
Yep.
So if you were trying to get a cost segregation study and say you have a realtor helping you buy a property, at what point what things get counted towards material participation if you're saying, hey, I effectively did everything? If you hire a cost segregation study, come in, you have a bunch of engineers walking through, does that suddenly count against you? Or working on the property, or if you have a realtor go do a walkthrough, does that count towards it? Or?
No.
Okay.
But that is a good question. So in section 469, they define material participation and what's called active participation. So like I am an active investor, I'm not materially participating. So active investing is like making decisions about leases. You know, like if he applies, I can be like yes or no. And if she applies, I can be like yes or no. And if a tenant texts me, I can respond, but I'm not where my properties are because they're out of state. And so like I can't materially participate in them. I'm just actively making decisions. Those hours do not count. So for material participation, it's very specific. So that's like doing stuff at the property. They also call these investor hours. So like reviewing your books, pulling a profit and loss, doing your taxes, looking on Zillow for more houses. You know, I don't know, researching new flooring from Home Depot and Lowe's to find the best one. Those hours don't count towards this. This is like time spent at the house providing that service or working on the property. So that is a very good question. There have been many, many tax court cases, and then I've heard, you know, just examples because they no longer take this stuff to tax court. But like attending educational classes don't count. Listening to podcasts, people have reported that doesn't count. Yeah, I just think again, mostly along the lines of like real estate, construction, development, like maintenance, stuff like that, that would count towards material participation. But again, like checking your listings online, not counting.
And then follow-up question, does it qualify if you buy the property within an LLC and you do it that way, or does it have to be under your title, under your name?
Yeah, good question. So LLCs don't matter because they're pass-through entities. So there's no tax impact of an LLC unless you elect an S corporation. And I will go on record saying don't put rentals in an S corporation, okay? That's kind of a common thing that has been recommended and people have done, and that is a nightmare. So don't do that. In fact, if you do, the benefits of depreciation I've talked about are gone. And the benefit of the stepped up basis at death, gone. So don't do that. Plus, then you have to start paying self-employment tax on that rental when you never had to. So no rentals in S corporations. So yes, it does not matter if it's in an LLC or not. Any other? Let me see. I can't. That must be it. Yeah, that's pretty much the strategy. Any other questions or anything?
I got one.
Yep.
There. So if you're a real estate professional and you get a cost segregation study, wipes out all of your, and then you want to go get a loan the next year, they look at your income, they're like, oh, you didn't make anything. Are they going to actually look at, oh, you didn't make anything on taxes? Or are they going to be like, okay, you didn't make anything, we're going to take away cost segregation for the loan?
So I have heard that depends. If you work with like a local bank or credit union, I've heard that can be really bad because then they look at it and they're not smart enough to figure out you had depreciation. But if you work with like a private lender or a hard money lender of some kind, or like the investment banks that do portfolio loans or DSCR loans, they will look into that for sure and take consideration of that. And one thing I think you just brought up that made me remember something too. If we're talking about cost segregation studies and maybe more so real estate professional status, but also short-term rental loophole, you can only use the losses to wipe out your income in a property that you materially participated in. So say you have 10 properties, you bought one new one, you materially participate in that new one, but you have depreciation losses in all 10, you can only use the losses from that one property to wipe out your income, not the other 9 because you didn't materially participate in them. The way around that is you have to group them, but that's an election you make and then it stays that way. And so that's not always best to do that. The best thing really, if you're thinking about doing this, is to find a good CPA or EA, which is enrolled agent. Those are like the 2 big tax pros. Find ones that specialize in real estate investing and know all the nuances of it. Any other questions or thoughts on this? Yes?
So I'm wondering, would that at all work with
Only, well, what do you define as midterm? Midterms don't exist in the tax code. 30 days or less?
No, not 30 days or less.
Okay, so 30 days or more. So those are rentals. Yeah, in the tax code, there's only rentals and short-term rentals or non-rentals. So according to tax code, anything 8 days or 7.01 days and higher average stay is a rental unless you provide substantial services. And then it's, 30.01 days and higher would be a rental still. Everything else is a short-term rental. So there's no such thing as a midterm rental tax-wise. It's just a rental. Yeah, anything else? Yes.
How would the cost segregation work with flips?
You can't.
Can't do that with
Nope.
flips. Okay.
So flips are considered, said this earlier, what is it? Inventory. So you can't depreciate inventory. So flips are held for sale. So if you intend on selling it, that's inventory. If you intend on holding it, that's an investment. So try to think inventory versus investment.
Dude, if flip that gets stuck and mired for whatever reason, you end up holding it for greater than 1 year, still considered inventory.
Yeah, so there have been tax court cases. There's one crazy one. I can't remember the exact details, but I want to say this guy owned some property, and this was more for a 1031 exchange. He owned it for like 20 some years, but the tax court proved when he bought it 20 some years ago, he had the intent to develop it and flip it, and they did not let him sell it because his intent had never changed, because he never invested on it. He never did anything else. So the way they looked at it, he was holding it to sell. So, yeah, don't smile like that.
So let's come back to me. I forgot the question.
Okay. Anyone else? Got to have one question for him to think. No, I'm kidding.
What was that?
You can ask me after if you think.
Okay, yeah, I'll come back.
Anything else? All right. Appreciate you guys.
Give it up
Good
for
luck.
Dan. So who wants to buy an Airbnb now? Raise the hands. Yeah.
Oh, I was going to make a shout out actually for these guys. So I'm under contract on an assumable VA loan, and the seller's leaving his entitlement in, so it could be a rental immediately. And I know these guys put those out on emails, so it's an awesome deal. We're getting a property for 2.875%, and all we got to do is pay the gap. 2021 interest rates and 2024 rents. It's a good arbitrage. So I was just going to plug that for you guys.
There's a lot of those right now.
There are a lot of those right now. So yeah, if you want any assumables, talk to me and Ryan about it. For Airbnbs, we also get a list every single morning on what properties do qualify to be a short-term rental here in Colorado Springs, because it's certain hoops you have to jump through with zoning and 500 foot away from another one. So make sure you let us know. And don't forget to sign in as well. We'll send you more notifications on next speakers, when the next meetup is. We do property tours sometimes, so if you want to come check out some of our short-term rentals, some of our co-living properties, we'll definitely let you know. Next meetup is November 14th, and for November and December, we're only going to be doing one in November, Thanksgiving, one in December, then Christmas. And so in November, we're having a friend of ours, Jordan Malera. He just bought a motel in Durango, doing short-term rentals on that. So he's going to come and talk, let us know his experience and how that is going. So thank you all for coming out. We'll be here for another 30 minutes networking. Make sure to talk to everyone you can, and have a good rest of your night.